Hello and welcome to today's GovMates Institute, where we get to talk about money and more specifically access to capital for growing government contractors. I am Meg Kearns, the marketing lead for GovMates and GovMates Consortium, and I will be helping to moderate today's event with the chat box and the Q&A and kind of the techie stuff as everybody gets in and gets started today. So jumping right into things here, I'd like to go ahead and point your attention to some participation reminders. So while we've all been able to familiarize ourselves with the Zoom platform, probably in excess over the past few months, here are some ways you can maximize your experience today. And that would include start by removing some of those distractions. So closing down the browser windows you don't need, silence the cell phone, minimize the email, and use headphones if you're in an office or a noisy place so you can get the full experience here and get all the information that our panelists are going to share. Go ahead and be active in that chat. You should be able to see toward the bottom right of your screen, there should be a chat box there. If you choose to all panelists and attendees in the dropdown that's right above the chat input, we invite you to use that as almost a digital business card this afternoon. So include your name, your phone number, your business name, and a website for those in the chat to connect with you should they want to reach out to you post-event. Make sure that, again, it does say to all panelists and attendees so everybody can see what you're sharing. Next thing is that we encourage you to utilize the chat box or the Q&A to ask questions you'd like our panelists to answer during the discussion. And then lastly, there will be a recorded replay. And we're going to go ahead and send that out post-event to the email that you registered with for today's Institute, which means I get to get into the fun part. And that is that I get to hand things over to our host for the next hour, GovMates co-founder Katie Billick, to introduce our speakers and get today's discussion started. So Katie, over to you.
Thanks so much, Meg. Well, good afternoon, GovMate Nation. Welcome to the virtual GovMates Institute. So today we're talking about money. So depending on who you are, that can be a really exciting topic, like for me personally, or it can be really boring and dull and monotonous, kind of like what my GovMates partner, Stephanie Alexander, thinks. So for those of you who are in the Stephanie Alexander camp, we hear you, we got you. We want to keep today's discussion as lively and as engaging as possible. So please stay awake, stay engaged, and ask questions using our chat box, just like Meg had mentioned. In all seriousness, access to capital can truly be a gating factor or a barrier to entry for government contractors if you don't know where to look or what tools you have available to you. Here at GovMates, we receive a ton of inquiries from our members on a variety of financing needs, from funding specific contracts or purchase orders to owner buyouts to acquisition financing. So the goal of today's Institute is to cover at a high level the capital structure and to educate you on the types of financing that are available to government contractors. We also want your feedback at the end to see if we need to dive deeper into a specific product or to a provider. So again, please take notes and give us honest feedback at the end. So shifting focus to today's panel, what I love about this group is that not only do we have experts from financial institutions that are at the top of their field, but they also specialize in GovCon financing. So they speak your language. You don't have to explain to them any of the acronyms. So IDIQ, GWAC, FAR, DCMA, they get it. So everyone you'll be listening to today has a very intimate knowledge of GovCon. So with that, I'm going to transition to introducing the panel. We typically kick it off with one question. So first, I'm going to start with Adam Nalls. Adam, who are you and what makes you an expert in your field?
Yeah, well, thank you. And I'm on your side of the camp, Katie, where this is a very exciting topic for myself. But I'm Adam Nalls, Virginia Partners Bank, and I've been a senior debt provider for the past decade, focusing specifically on GovCon, help with lots of transactions from simple working capital all the way to M&A, dividend recap, partner buyout, ESOP. So very familiar with this, the debt structure. And also what the people on this panel do a great job is they know not just what they do, but what everyone else in the industry does. So we're very active in when something's a good fit for Katie or Claudio or Jason. If you call someone on the panel, we can also get you pointed in the right direction if it's something we can't help with.
Thanks, Adam. All right, next we'll do Claudio. Claudio, tell me, who are you and what makes you an expert in your field?
Hey, Katie. Well, thank you so much for having us. My name is Claudio. I'm the managing partner of Donovan Capital Group. Donovan is an investment firm that invests in businesses that work with the Department of Defense or the intelligence community. My own particular background was at the CIA, and then after that at the White House. After that, had a short career as an attorney before becoming an entrepreneur myself. Founded a couple of businesses, which I was able to build to an exit. So what we try to do at Donovan is sort of bottle that knowledge, as well as those of my partners who come from a government background, and to be able to be a strategic partner for the businesses we invest in.
Very cool. Thank you, Claudio. Finally, Jason, tell me, who are you and what makes you an expert in your field?
Hey, Katie, thanks very much. And thanks to GovMates. I'm Jason Kaufman. I'm president of the Chertoff Group. We are a advisory and investing firm focused exclusively on the security markets. I've been an investment banker and investor focused exclusively on this sector for 25 years, with the Chertoff Group for about 10. Most recently, at the end of 2020, we established a private equity growth fund to focus on security companies. So we raised some capital on the back of some success that we had investing in cybersecurity companies over the last 4 or 5 years, and are now actively looking to make new investments into the sector.
Thanks, Jason. So you have a unique perspective, given that you're wearing two hats, really. One, having a fund, and then two, being an advisor. So thanks for joining us, everyone. Meg, can we turn to the next slide? All right, so typically I don't like slides, and per Stephanie, they are boring and dry, but I think having this in the background as an overview of the capital stack is going to be helpful in kind of illustrating where we're talking about. So anytime these guys are speaking, you can reference the slide to figure out where they fit in the cap structure. So kind of diving into this, kind of the first question to all the panelists, tell me where you fit into this capital stack and why government contractors would come to you for financing. Adam, do you want to start off with that?
Yeah, sure. As you can see, we're at the bottom of the capital stack. We are the cheapest source of capital available as your senior debt provider, typically, structured as a bank. So that includes your working capital revolver, and then typically, some sort of term facility for either growth capital, contract mobilization, or buyout. But as a senior debt provider, we are having the lowest pricing, 3, 4, 5% range, but we're also the most limited in the terms and conditions we can provide. We don't have the ability to stretch, the level of multiple EBITDA the other providers have the flexibility to. And we're really underwriting more to what's in the backlog, what's in the recompetes, really what's more quantifiable revenue visibility compared to some of the other providers that share different upside that they'll talk about shortly.
Thanks, Adam. All right, who's next? Claudio, Jason?
Sure, I'm happy to go. So we at Donovan focus on mezzanine debt. We do a couple other products, namely structured equity and unitranche debt, but I think those are a little bit beyond the scope of this conversation. But for the purpose of this conversation, mezzanine debt is basically junior debt. So we sit behind Adam. And what makes us unique lending against the assets of the business, we as a firm look to the cash flow of the business. So we can lend beyond the value of the assets, usually as a multiple of EBITDA. One of the advantages that we have in comparison to equity, on the other hand, is that the cost of our capital is really by interest rate. And so we don't take equity in a business the same way as an equity investor would be. So we're really a great compromise between both of those ends of the spectrum. And they're very unique situations where I think mezzanine debt is a great tool for businesses looking for growth capital, as well as businesses looking to acquire other businesses in the space.
Thanks, Claudia. And we'll dive a little bit more into mezz debt in a little bit here. Jason, you last, where do you fit in the capital stack?
Yeah, so we are growth equity investors, which is a category of equity that sits really later stage than venture capital, and really kind of pre-buyout PE. So what does that mean? We typically put to work somewhere between $10 and $25 million of capital into any given deal. We're willing to take a minority position or control. We also often invest with partners where the two of us combined will have a controlling position in the business. And our capital is typically used to facilitate reinvestment into the company, along with some liquidity for the founders who may be looking for a transition of leadership, maybe take some chips off the table, but to remain actively involved in the business. our companies typically will have somewhere between 15 and $200 million of revenue, so quite a wide range. We're not necessarily looking to underwrite losses. Our companies will typically be break even, or at least where we can see a path to break even in the business. And really what we like to see is a mix of capital that's going to the balance sheet to facilitate growth, reinvestment in the company to accelerate growth in the business. Maybe you have an interest in building out additional pipeline, additional sales channels, some back office infrastructure to fund an acquisition, or even potentially some internal R&D type projects. And then oftentimes, like I said, you'll also see some aspect of liquidity going to the existing shareholders of the business.
Got it. Thank you, Jason. I was taking notes. You're talking about control or minorities, so we'll cover that a little bit later in this conversation. So at a high level, there's really two types of capital. You've got debt and equity. So first I want to dive into the debt side of things. It's kind of more addressed to Adam and Claudio here. So first, market rate for debt. So Adam, I heard you talking about senior debt. It's priced in this single digit effective interest rate range. That's what folks should be expecting from a bank.
Yeah, 3 to 5% range. But so the reason the debt is up.
Fed / interest rates to like zero. Like, aren't we doing quantitative easing? Like, shouldn't I get like 0% interest rates from you?
I wish we could, but we do need to make a little bit of money on our side. So we are lending grandma's savings account out. So we need to make sure we get it all back at a safe rate. But yeah, market rates, 3 to 4%, all-time borrowing lows. So it's a great time to be taking on debt, a terrible time to have a huge savings account earning 0% interest.
Got it. So that interest rate is the same for, say, a line of credit revolver as well as term debt?
So the term debt typically is going to be priced 25 to maybe 75 basis points higher than the revolver. And then the pricing on the term debt is typically be based on kind of how much, the EBITDA is relative to the total debt load. So the banks, may be able to leverage, the EBITDA 1 to 3 times, depending on the size of the EBITDA, but most importantly, based on the waterfall in the contracts in your backlog. That is a repayment source. The revenue visibility from that waterfall. What are the contracts? What are the gross margin? What are the recompetes? And then you start talking about really what is the transition plan. If your business is growing from small business to full and open, how are you going to transition those contracts that are legacy small business to full and open? What is that strategy and what does it look like? That'll drive the debt structuring your bank provides.
Got it. So when you mention term debt, what's typically the length of time for a term loan for an average government contractor?
So you're going to see anywhere from 3 to 5 years typically. Sometimes you'll see a much larger amortization, but those are typically be, once you break EBITDA of $10 million, that's when the flexibility really starts to come, create more flexibility. But for companies in the $1 to $5 million EBITDA range, it's going to be a 3 to 5 year AM. And then the bank's going to want to see some sort of collateral coverage, typically within maybe 18 to 24 months, depending on really what's in that waterfall. And a simple thing the banks look at is what is your backlog, funded and unfunded to revenue. So the industry average is 2.5 times. So if you're going out to get debt, you want all brand new 5-year contracts and your backlog is 3 to 4 times revenue, you have great visibility, very easy for the banks and even Claudio to lend further into that EBITDA because of that visibility. If all your contracts are coming up for recompete in the next 6 to 12 months and it's one turn, it's really tough for the banks to lend into that because you're taking all this recompete risk. And then really when they're looking at the recompete risk, it's, are you still eligible for those contracts? So if you've grown out of the side standards, you've grown out of a set aside program, where are you in the program and what's the strategy? Those are the key drivers of your debt capacity.
Got it. So Claudio, on the mezzanine debt side, the sub debt side of things, what is you had mentioned more expensive pricing, but what exactly does that mean from a rate perspective?
Yeah, so I think the important thing to keep in mind when you think about mezzanine debt is that, as I said earlier, we truly sit behind Adam and the products that they come out with. So we are junior to them, and we are the riskiest part of the debt structure of the business. As a result of that, what businesses can most typically expect to see in the market is an interest rate anywhere between 8% at the low side, to up to about 16% on the high side. I'd say the most typical range is 8 to 12%. You do see some outliers within that. But again, that's a reflection of the fact that, as Adam talked about, when you're talking about certain business, for example, services businesses that don't have a lot of hard assets to lend against, or businesses that don't have a 5-year contract backlog. Those are the type of businesses where if you are looking for debt financing, probably the best place that you're going to find the most options and frankly the most capital is with mezzanine debt. And so that is a reflection that gets reflected as part of the interest rate and how we look at particular deals and how we price those deals.
Got it. So typically with mezzanine debt, there's warrants associated with that. So can you give us a little feel for like what the hell are warrants and how do they play out?
Yeah, so there are two parts to how we charge for our investment. The first is the interest rate. The second is warrant coverage. I will tell you that most mezzanine firms will be generally upfront with the companies they invest in. Just as Adam has limited partners and investors that he has to report to, so do we. And so we have a targeted return that we seek to make on any particular investment. And we get there with a combination of the interest rate and the warrants. And those two things can move opposite. So if we have a higher interest rate, we can lower the warrant coverage. If we have higher warrants, we can lower the interest rate coverage in order to get a targeted rate of return for our particular investors. The warrants themselves are really designed to compensate us for that extra degree of risk that we are taking compared to an asset-based lender. And so the warrants really are a ability for us to purchase stock in the business at a set price for a set period of time. And again, it's not a number that's sort of picked out of air. It's a result of a model that we build where we target a particular rate of return, and that essentially gets us the delta between the interest rate and what we need to return to our own investors.
So what percent is that on average? Can you give a range?
You know, it's going to, a lot of it's going to depend, for example, on what we think the growth of the company is going to look like, what we think the value of the business is going to be at the end of our term. And I should talk about here, our general investment window is anywhere between 3 to 5 years. So when we think about the value of warrants, one of the questions is, well, what do we think the business is going to be worth 3, 4, 5 years from now? And so it's hard to give a set percentage, but I have seen it as low as 2% and as high as 8%. So it really does vary.
Got it. And do you always exercise that option then, or can warrants go unused?
Yeah, so I think that's a great question. At least for Donovan Capital in particular, we are not looking to be shareholders of the business. So our goal is not to exercise the warrants and then become shareholders of your business. Our goal is to be able to capture some of the upside that, frankly, Donovan helps bring to businesses, not only because of our capital that we're lending to the business, but also what we try to do on the strategic side to help us capture some of that upside that we help grow the business with. And because of that, what we look to do with the warrants is really just exercise the value of the warrants. And typically the warrants can either be structured in one of two ways. One, they can be tied to some sort of liquidity event in the future. So if the business does have an IPO, if the business is acquired, at that point, we would then exercise our warrants and get that cash value. Or there can be a time limit to that essentially at a certain date, we would exercise the warrants to get the value of those warrants. But the goal is really to capture the economics and not necessarily to become a shareholder of any particular business.
Okay. So just kind of recapping that at a high level on the debt side of things, you've got Adam, he's got basically lines of credit or revolvers, asset-based lending. He also within the bank has term debt. And then Claudio has term debt as well. So between Adam and Claudio, if I'm looking for term debt, who do I go to? Explain a scenario where I would go to Adam as opposed to Claudio or vice versa.
Yeah, so it really comes down to what's the objective, what's it trying to accomplish, because the bank term debt's going to have a very rapid amortization with principal interest payments, and we're really underwriting the backlog. So the first question is, can you get term debt from the bank, and what does that look like? And then the other thing I think is, Claudio, for your debt, what is the repayment? Is it interest only typically?
We can do both. We can do interest and cash flow. Yeah.
Yeah, so I think a lot of the question drives around what are you trying to accomplish, and what do you want the cash flow? Is it if the bank gives you a 36-month term loan, the majority of your free cash flow is going to the bank. If Claudio structures an interest-only piece, you have more cash flow available for other activities, organic growth, reinvesting in the business. So you need to look at those two and figure out what do you want to do with your cash flow? What are the goals? What are you trying to accomplish with the cash? Because the bank is going to be much more limited on how they structure the term debt.
And I'll also add in, look, Adam is always going to be cheaper. Of all the sources of capital, he is the cheapest source of capital. And so we certainly encourage companies to look at asset-based lending for capital. But I think one of the things people should keep in mind is that we work together. More often than not, we're both involved in a particular business. And so we will look, and I'll give a call if a company came to us, I would call Adam and say, how much are you guys lending? What do you think about the business? And then we would make an internal determination about how much more we're willing to lend on top of, and frankly, behind Adam. And so we really do work together. And so there are times where we could just be the direct lender, but other times, and I think more often, we are actually working with or behind an asset-based lender like a bank, for example.
That's great to hear that you guys work together and that you can coexist peacefully, because it's great when things are going really well, but when things go horribly, when things go south, I think it's very important to know everyone who is sitting in the cap structure that you guys can play nicely and communicate, because God forbid you lose a recompete, a contract is terminated for convenience or for whatever the issue is, and there needs to be pretty tight communication amongst all parties who are involved there. I want to transition a little bit to cover the equity side of things. So Jason, this is kind of your wheelhouse here, having a growth equity fund. So if I'm a government contractor and I'm looking to raise equity, some folks are definitely in the market for it. Other folks could get scared of giving away equity, thinking they're giving away upside. So as a government contractor, what do I need to be concerned about, specifically with my government customers? Am I going to have to get approval for them? Like, does this make me look weak, or is it a point of strength? So as a GovCon, what should I be thinking if I'm taking on equity?
Yeah, sure. Those are great questions, Katie. And I would say that a few reactions to that question. The first is that over the last 5 to 6 years, I would say government customers, just in my conversations directly with them, have become very open and receptive to the idea of having a private equity investor come into the business. It's become so common, right, across the industry, that they've become much more receptive to it. In all of our discussions, typically when you message it to the customer, you don't necessarily come out and say, hey, we've just brought in a private equity sponsor. I took a bunch of cash off the table and I'm disappearing. We don't invest into those types of situations anyway. It's typically much more a message of, hey, we just brought in new equity capital and a backer to help us bring more capability to you, to deliver more people, more technology. We're going to be adding businesses. This is going to be a growth platform. It's going to attract a lot of new talent to the business. And all of those positive factors are only going to help us to deliver the mission to you as the customer. I would say, I think it's a fair point to say that in some of the discussions that we've had with government customers in the last 12 to 24 months, there's an increasing awareness that the path of private equity typically will lead to an exit subsequently down the road 3 to 5 years from now. Like Claudio, our typical hold period is somewhere between 3 to 5 years. And so I think the government customers have gotten quite smart that they understand that when private equity comes into play, it means that at some point, there's going to be a transition to a larger corporation. And they've generally made peace with that and understand that. I think it in some ways benefits some of the smaller companies that may be on this call, because some of those customers are saying, I have to continually reinvest in my small businesses because I know that over time, the Leidoses and Booz Allens of the world are going to come in and buy these private equity platforms that are consolidating the small business base. It's been a really interesting trend over the course of my career to see, early in my career, kind of late 90s, you would see, the likes of L3, CACI, Mantech come in and buy a $25 million business, a $50 million business. Those are really hard to find nowadays. It's much more common to see a Leidos come in and make a $300 to $500 million acquisition. It's very difficult to get them to pay attention to a business that's sub $100 million in revenue. And so really, private equity groups have played an interesting market facilitation role of bundling some of these companies together, turning it into something that's more attractive from a size standpoint for the acquirer, maybe de-risking some of these small business concerns, getting them through that transition period, taking on that risk themselves, and then turning around and selling that business to a large acquirer. But there are other considerations to take into account as well for a government contractor. The first does have to do with that transition from small business to full and open. Typically, if you're selling control of your business, you will traditionally lose your ability to continue to win new small business contracts. Existing IDIQs, you can likely continue to win new task orders underneath that IDIQ. You could run out your existing task orders, but it will inevitably create some headwind in that small business category and accelerate your transition to the unrestricted space. So I think overall, as a business owner, as you're thinking about private equity selling a majority control of your business, you should be thinking about that as a factor, and certainly it's a risk factor that we spend an awful lot of time thinking about as well. I'd also say on the minority side of things, that's probably an area where it's easier to facilitate that transition because
when you
minority control. Yeah, less than control of a business, selling less than 50%, but 51% of the business. It's easier to structure a transaction and an investment in a way that doesn't necessarily trip over those small business regs and enables the company to continue to win small business contracts. So that question of a controlling position in your business versus a minority share of your business is something that's an important consideration to take into account as well. But in either circumstance, you really should be thinking about partnering with a private equity firm that you've built a relationship with, that you trust, that understands the sector, because you want to be spending time building your business and not educating a financial sponsor on all the big acronyms that Katie was using at the beginning of the conversation.
Jason, when you talk about customers, your government customers, I mean, on this call, we have a wide variety of customers that are represented. We've got folks in the IC who might very much be concerned about how their customers are reacting. So is there a difference in, DOD, IC civilian, what have you, reaction to private equity sponsors coming in, or is it just a case-by-case basis?
Katie, I think it's case by case. Through our consulting business, I've interviewed lots of customers to ask them about their vendors and get a sense for how they would react to a potential transaction. I've never had a bad reaction to a company finding out that a private equity investor is coming in and backing the company. They always have looked at it as really a net positive for the business. I think if there were a case where maybe a financial sponsor was very sort of debt heavy and financial engineering focused, and was going to put a bunch of debt on the company and really wring it for cash flow as opposed to investing for growth, that might make them a little bit concerned. But the messaging has always been around growth and conservatism and making sure that the customer mission isn't impacted. And that's I think job number one. I would say that the mission focused customers like you described in the intelligence community and DoD are probably the ones who want to make sure more than anything, hey, is my guy, whoever or lady, whoever my ultimate belly button at that contractor is he or she staying, and will I still have access to them? And as long as they're confident that there's going to be that continuity of service, they're typically good to go.
Got it. So at a high level, for any of our folks who have small business set-aside status or SDV, OSBs, et cetera, if they want to bring in an equity sponsor, their only option would be a minority investment. Is that right?
Yeah, that's typically the case. There are some SBIC, small business investment corporations out there that are typically structured more as lenders versus as equity investors. That enable a company to take on a decent amount of capital, and because of their support from the Small Business Administration, they are sort of grandfathered in and are exempt from a lot of the regulations. But generally speaking, yeah, if you are bringing in an equity investor into your small business, you really want to make sure that you structure it as a minority investment, if part of your growth plan involves continuing to win small business contracts.
Got it. I want to, now taking a step back, kind of a question for all the panelists then. What makes for an attractive investment for you? What are you looking for when you provide capital to a government contractor? Adam, let's start with you. Whenever you're lending to someone, either providing a line of credit or term debt, what key things are you looking for?
Yeah, I mean, I don't want to get too, the main number one thing starts with, I would say, management. What is the management team? What is the strategy? What are the key services? And kind of underwriting the other key aspect, the backlog, and really the infrastructure in the business, their ability to, accounting, timely reporting, and really their ability to have basic financial, strong financial profile of are they making money? Do they have capital in the business? Those are the things we're looking for. We don't have to underwrite as much about future. We're not underwriting enterprise value. That is not a repayment source. Our repayment source is, are they making money from their contracts? It's pretty vanilla.
When you mention infrastructure, like accounting, back office support, I mean, a lot of our members outsource that stuff. Is that a bad or a good thing?
Normally that's great. I mean, we like that because it provides some depth. I mean, it's a tough for small businesses. If you have one person do accounting and they get sick, or in today's world, they get COVID and they're out. It's good to have, a team that can provide infrastructure support. They can go to get questions. It's really a great way to scale the business. I mean, the key thing which we love about the business, variable cost, variable revenue. So as you grow the business, you can build the back office. And if for some reason a contract rolls off and you don't have a ton of fixed costs, you should be able to kind of make money at various revenue sizes. And that's the the core thing about GovCon that banks typically like.
Got it. Claudio, what makes the most attractive target for you guys? Are there any, verticals that are most appealing right now?
Yeah, so I'll take one step back and just say from a basic viewpoint, I think there's a negative to debt and there's a positive to debt. I'll start with the positive. The positive being that your equity is the most valuable asset you have. And so one of the positives of debt is that we don't take equity in the business. The negative of debt is that you have to pay us back. And so as a debt investor, one of the things that I look for is the ability of a company to generate enough free cash flow that it can service the debt, that it can pay back the amortization of the debt, and it can pay the interest on the debt. And so the most critical thing that I look for, just like Adam, is I am looking for steady, predictable, high visibility revenue. I'm looking for a business that has a demonstrated history of being able to manage operating expenses and to be able to generate positive EBITDA and there's a historical track record to be able to do that. In terms of the businesses we get most excited about, I think you hit on it, Katie. We do have certain themes of businesses that we love to see because we think that's where the budget's going. We know that this particular customer is looking for that capability, or quite frankly, that there are people like Jason who are looking for customers in that vertical. Because at the end of the day, my goal, if we are a direct lender to a business, my goal is to help get that business to a position that it's more attractive to Jason and his firm and other firms like it. So we do care about certain themes that we think private equity investors care about. And those are all the basic ones that I'm sure everyone on the call knows about. But I will say that doesn't exclude other businesses from coming to us. And we love to see all different types of businesses doing all different types of things. We are more focused on, is this a well-built business that is positioned to continue to grow and has the ability to continue to scale so that it does become attractive to someone like Jason a little bit later on.
Yeah, and I think from our perspective, we look for, it's right there in the name, growth equity, right? Growth is really the number one factor that we're looking to get excited about. And really what we're especially interested in understanding is how can our capital, if it comes into the business, facilitate an acceleration of that growth, either by putting money into the business to, again, make sort of inorganic growth investments or to fund acquisitions, and to facilitate perhaps a transition of leadership and ownership from one generation to the next. As a great example of that, we invested in a company 5 years ago called Delta Risk. They were a professional services provider of cybersecurity services to predominantly federal customers. So they were providing, pen testing and, cybersecurity risk advisory services. a small company doing about $7-8 million in revenue. The owners were ready to move on. And what they really saw in the business and what we saw was an opportunity to transition the company from being a pure professional service provider to a managed security services provider that would sell their services on a subscription basis, to build a security operations center where people could be staffed and have just a completely different revenue model that was much more profitable. But we saw that to be able to do that, we would have to make serious investments into infrastructure and perhaps even run the business at a loss for a couple of years. And so we facilitated that transaction where the owners left. We brought in a new CEO to run it. We put multiple millions of dollars of capital onto the balance sheet to build out that security operations center. And then over a 5-year period of time, the company transitioned. They made a couple of acquisitions to add some technology into the company. They grew both federally, but then also commercially, until by mid 2020, we were able to look at it and say, okay, now we're a completely different business. We're a managed security services provider selling a subscription model versus a professional services labor hour model. We had a mix of commercial and federal clients. And so we were able to exit the business based on a multiple of revenue, where we bought in as a multiple of EBITDA. And that transition and really transformation in the business was facilitated by a combination of our capital and our network by bringing in leadership to execute on the business. So that's the type of thing that is a sort of perfect model for us, where we can see the opportunity to really accelerate management's plans by adding some fuel to their engine.
You definitely had a lot going on there with Delta Risk. You had a change in management, you had a change in business model, and then ultimately a change in how the business itself was valued. So congrats on that success story. I'm monitoring here in the chat box. I have a question here, and it applies to all of you guys. How has COVID changed your tolerance for short-term losses in a business? Who wants to jump in and take a stab at that?
So I'll go first. I mean, kind of, we think about COVID, it's one of those things that obviously no one saw really come, well, very few people saw coming. And we really kind of, you take a step back, pause and say, okay, was this a blip in the business? And if it's short term, by definition, hopefully it is. And what is the long-term outlook of the business? And what does that look like? So yeah, a lot of businesses took bumps, in government services, less of bumps in other industries. But we tried to have a big picture view of what does the business look like going forward? In our industry, we joke, loans are never repaid from past year's earnings. It's kind of future earnings. So we think about what is the outlook of the business and less about what just happened, really something that was probably Q2 of last year. We now have Q3, Q4, we're even into this year. We can really see what the business looks like in today's environment, not just that quarter when COVID really took full effect.
When you say short term, I mean, this is, we're 10, 11 months into COVID. What if folks are still struggling, up to this point? Is that short to you, or?
Everyone's really a case-by-case basis. I mean, I know we just kind of take a look at what happened. We just ask why and, why and what happened and what's the strategy and what's the plan. So you just have to, look at if we couldn't get our people on a base for, a quarter to do work because of COVID, where are we now? Can we do that? And the intelligence committee is at 3610 they're billing for, and what does that look like when that weans off? So we kind of just look at everyone by case basis and really think, what does the next 12 to 24 months look like? And that's what we're really focused on, not what happened. We want to understand what happened, but that's not the sole driver of our decision.
Got it. Claudio, how has COVID affected, the portfolio companies that you guys have, if at all?
Sure. It certainly has, and I think our analysis is very similar to Adam's. The one thing perhaps that we also look at is, where has that work essentially shifted to the right, or has it disappeared? So that's an analysis that we do on our end. We want to confirm that there is not a systemic problem. In other words, that as there's budgetary constraints, this type of work is going away, or these contract vehicles are no longer going to exist, or this customer is not looking for that capability anymore, or this type of work is going to be done by larger and larger primes, making it harder for smaller contractors to be able to win that business. So that is certainly something we look at. But I will say that there's sort of two questions that we answer. One is, can we invest? And the second is how much we can invest. So simply the fact that last year revenue may have gone down and profitability may have gone does not disqualify us from investing, but it certainly doesn't affect how much we may be willing to invest in a particular company. Because at the end of the day, again, we have to get comfort that the business is in a position to continue to not only maintain its revenue, but to continue to grow at a reasonable growth rate. You know, we're usually talking anywhere between 10 to 15% year over year during the period of our investment. The final thing that I'll say is, while we certainly don't have as much flexibility as someone like a Jason would, we do look at opportunities where, frankly, we think that we can bring some value to the team, and we can help the team either diversify to go after different opportunities. We can help the team professionalize its BD operations. We can help the team find other customers. So if they've been focused on DoD, how do we get them into the IC? And so if there's an area or a particular business where we feel like we can help accelerate and help foster growth within that business, we'll certainly do that. And then it becomes an attractive investment opportunity for us. But I think the key part is, are the fundamentals of the business sound? And to analyze that, we not only look to last year, but we'll look to the year before that and the year before that. And it will truly help us understand if last year was simply an external factor that had nothing to do with the fundamentals of the business, or was it something that was an existing problem that COVID simply brought to light? And so that's the analysis we look to do on our end.
Got it. Claudio, I'm glad that you mentioned that you guys really look to help on the business development side for your portfolio companies. I think that's a key differentiating factor for you guys, and truly shows that you're a great financial partner, an actual partner for a government contractor. And I think, you know, Adam and Jason also share a similar mindset in the companies that they're supporting. Jason, specifically on COVID impacting your tolerance for losses, if you will, in business. Has this created opportunities for you guys? Are you finding more, distressed properties, if you will, that you guys could step in and be helpful with?
We haven't seen a whole lot in the distressed world. Instead, because most of what we do has been historically in cybersecurity, I would say that many of our companies were actually net beneficiaries of COVID. We were investors in a company that was just acquired last year by Palo Alto Networks called Crypsis. They were a cyber incident response company. So, competitor with Mandiant. That's a company that in a 3-year period of time, essentially grew from 5 million in revenue to 55 million in revenue, just by virtue of the explosion of ransomware and phishing attacks that people have been subjected to since they moved into a work from home environment. So we saw opportunity as well. I would say on the most of the companies, in large part because of PPP, we haven't seen many companies that have had serious distress, and most have been able to manage through it in a fairly controlled and competent way, albeit painful, certainly. But we haven't necessarily seen companies sort of dip into the red. What I would say is that what we're trying to monitor most closely is just procurement delays that have stemmed from COVID. We had such a long period of time last year where procurement shops just completely shut down, and it feels like even still they're just getting back to work. And so we normally, when we're having conversations with potential targets, and they're talking about their existing pipeline, their recompetes, we're really making assumptions about extending those award dates, extending those RFP dates, and making assumptions about bridge contracts being put in place, because this is going to take we think 12 to 18 more months just to unwind and get back to a regular pace of procurement. So I think that's the one thing, is that when we look at growth projections, we think the company could be absolutely right about the opportunity, about their position to win, about price, about all those things, and competitive dynamics that could put them in a favored position to be successful. We're just asking a lot of really hard questions about timing, because it's a little bit unknowable right now.
So not to digress too much off of financing, but I'm curious on procurement shops that are kind of delayed, if you will. Can you speak to which specific, customers are maybe everything's being pushed to the right? I mean, anecdotally, folks on this call would like to know if their customers.
Oh, Yeah, I wouldn't want to get too much into specifics, Katie, but I would say that particularly within the intelligence community customer set, the Maryland customer, the Virginia customer, we've certainly seen them have, slowing down quite a bit. And even within DoD, I would say we've seen some delays within sort of the OSD level, type contracts. I'm not sure, Adam and Claudio, if you guys are seeing similar things.
I think you hit the nail on the head. I mean, when we think about things, we look at the models, we just try and push whatever their projected start day is out. We just 90, 150 days, 120 days, just need to kind of push those dates out and start thinking about structuring debt. It's just, nothing's happening on time. It's kind of the normal for now. And we just need to structure things for that assumption. And that's just kind of how we've done it. And I think it's kind of created, in my mind, shorter backlogs because no one can get to the recompete. Like everything's like, I should get this recompete. And my other, so normally it's a 2.5 year average. It's probably now the industry is probably 2 years because they keep getting these 6-month bridge contracts. So their total contracts are shorter, and it makes it tough when they want to do transactions or really get lots of leverage because they just don't have those long-term contracts now.
I'm seeing another question here in the chat box. Do Adam, Claudio, and Jason all work together for the benefit of the business? And I will answer that one, and I will say yes. I think that's kind of a good segue into one of our next questions is I'd love to hear kind of case studies, how you guys have worked with other lenders in the cap structure, be it for an acquisition, what have you. But in many scenarios, there is a private equity sponsor, you've got sub debt, and then you've got bank debt. So I throw it out to the panel. Would love to hear kind of case studies and success stories. Acquisitions are fun to talk about, where you had been adjacent to other lenders and how that panned out.
Sure, I can go ahead and get started. I think the short answer to the question is absolutely. I know from an outsider's perspective, it feels like, here are these guys that are charging these interest rates or asking for these terms, and there are thousands of legal documents involved. But I will say the fundamental goal of what we do at Donovan, and I'm sure what Adam does, or what Jason does, is we look for opportunities where we can truly partner with a business. Our particular who we are at Donovan is to be entirely transparent. So I don't want to put more debt on a business than the business can handle. I want to invest and make sure in a healthy business, and I want that business to continue to operate as healthy as possible. And so in that sense, I think our interests are very much aligned with the founding team. I think the one area where we potentially sometimes have seen a little bit of a digression is where the founding team perhaps wants to step on the accelerator a little bit more. And there are certainly mechanisms that we can put in place if we ever get to that point. But more often than not, we are entirely transparent. We share our investment model with every company we invest in. We walk through how we think about the business and how we think about the modeling, what we think the business can achieve, and how we can help that business help to get those goals. And so for me, I'm very proud of the fact that Donovan does have that relationship and that partnership with the target companies. In regards to how we work with everyone else on this, you gave the example of an opportunity. Most typically, I will tell you that companies, if we get the call directly from a company, I'm the first to call Adam and I'm the first to call Jason and tell them, I think this is a business that you can help. Either because you have a cheaper form of capital and I think we should maximize that for the benefit of the business, or two, frankly, Jason, you're better positioned to help step on the gas of this business than I am. But I think I can serve this particular function of that business. So I have always had I'm trying to think of a recent case study. We most recently had a business that does MRO for the Predator and the Reaper. And that was a business where we brought in a bank that basically provided financing against the inventory that the company did have and against some of the accounts receivable that it had. And then on the private equity side, there was a group that came in and said, hey, we can actually help this business not only do work for the Predator Reaper, but also for the F-22 and the F-35. And we want to make a capital investment in the business to build out a team to help the business do that, as well as focus on some of the internal operations of the business. And I think that's an area where, frankly, equity investors like Jason are really well positioned, because they really do look at the whole aspect of the business and how do we professionalize and help the business get to the next stage. And when we each sort of play our particular part, I think we're very good strategic partners in helping businesses get to that next stage.
Yeah, I think a lot of that drives us, all of us try and work with partners in the business and understand what their strategy, what their goal is. And the other thing I say is, what is their risk tolerance? So how much debt do they want in the business? So maybe someone who's got a higher risk tolerance, it's going to be more myself and Claudio, because they want to keep the equity for themselves and maximize debt. But someone that maybe is, I had a recent deal where the business was buying another company and they just had a lower risk tolerance on the transactions. They brought in a little bit of equity, someone like Jason, because they didn't want to have to lever the business. The ownership team just didn't feel comfortable really leveraging the business. We would have lent them more money, but really discussing them, that wasn't a fit with who they are and what their strategy was. So it's really just what's not about what we can also do, but what's important to them and where they want to take the business and where does it fit with them personally. Because some business owners just sleep better at night. Everyone's got a different profile, and what's the right combination to meet the strategy and the business owner profile.
Got it. I've got another question here in the chat box. And Adam, this is probably going to be directed to you. There's one of the members, sounds like they're using more expensive kind of non-bank lending. How can they, graduate out of that status to obtain bank debt to help them recover more quickly? So what would you be looking for in a scenario where someone is, say, factoring or using a non-bank lender to get to bank debt status?
Yeah, the simple thing is try and find one or two banks to start having a conversation with. And really the goal would be, hopefully they could help you now, but they're looking at the backlog and your profitability, and then kind of looking at what would your adjusted profitability be if you weren't paying the factoring expenses. And most of the banks, I'm always happy to talk to people about, like, if we can't help you today, this is when we can help you. This is what the profile needs to look like. What do we need to do to get you there, and kind of have that conversation. And we're also great about introducing people. Like, certain banks have certain profiles. So I may know it's not a fit for us, but it's a fit for, ABC Bank and ABC person, or it's a fit for Katie. If you get people in the government contracting financing world, we will always try and help you and point you to the right person if we're not the exact right fit.
Adam, maybe a dumb question, but you've got Virginia in your bank title, Virginia Partners Bank. So does that mean you only lend to Virginia companies?
No, so right now we're pretty much focused on businesses on the East Coast and kind of within, I'd say, like 1 day's drive of where we're located. We'll go out of the area, but we typically are looking for businesses that maybe perhaps a little more scale, a little more size. It'd be tough for us to do a complete startup on the West Coast at this time.
Got it. So GovMates, take note, anyone who's as far up as, say, New York, Boston, all the way as far south as Carolinas?
Yeah, Carolina. Yeah, that'd be good for kind of now. And we'll, if you call us, we'll point you in the right direction if we can't help you, depending on where you are and your size. And Katie probably knows every banker in every town in the United States.
Another question from the chat box. What's the minimum revenue amount that a firm needs to have in order to engage with any of you guys?
So I'm happy to go with that. And I'll actually just pick up on the last question to Adam. That has been a case, frankly, where we have, a company has had high factoring interest rates that it was paying off. And so they essentially came to us, used our capital to basically refinance that. And then they paid us back within 2 years. So we certainly have, there's certainly ability for people we work with to prepay the loan that we provide and essentially refinance us out, sometimes with equity money. In regards to the question about what we look for as our criteria, at Donovan, we typically like to see businesses that are doing between 10 to 100 million in revenue and at least $1 million in EBITDA. For certain businesses that we feel very strongly about, we can look at businesses that are doing slightly below 10 million, but that $1 million EBITDA is really key for us because, again, our focus is on, is this company in a position where it has generated enough free cash flow that it can pay us back. And I think this ties, frankly, into the COVID question, which is we are tolerant of businesses that can have a dip in revenue and a dip of EBITDA. But one of the reasons we build in that margin of at least $1 million is we want to make sure that business can weather those dips and is in a good position to weather those dips. And we will work with those businesses. Last thing we want to see is a business that struggles. And so we will certainly work with those businesses to help them weather it. But that's where that 1 million comes in, at least for Donovan's perspective.
Okay.
Yeah, it's very, very similar for us too, Katie. 15 million of revenue is our typical minimum size threshold for a services business. We like to see around 2 million of EBITDA. For a product business, we're more comfortable with perhaps a company that's break even, or at least a path to break even, where maybe you can see some reinvestment that's going on in the company from existing cash flow to accelerate growth. But generally speaking, that's where we fall out. From an ownership standpoint, our minimum is usually, we want to make sure that we own at least 10% of the business. We kind of call it influence capital. We don't necessarily need to be in a controlling position like we talked about, but we need to make sure that we have at least, the ability to influence the capital, influence the direction of the business with a seat on the board. And then typically, if we're in a minority share position, we look for some sort of, protective rights to protect our investment. But generally speaking, 15 million of revenue is kind of our threshold.
Got it.
Yeah,
And Adam, how about you?
So typically our minimum revenue is probably around $1 million. We're a little more flexible, lower down the food chain. And then we kind of relate not just where you were last year, but really where you're going, what's in the backlog. We look at all those things together. So there's not like a hard minimum, but we do want to see businesses that are growing have the ability to be, 3 to 5, $10 million revenue businesses in the near short term.
Got it. So we've got just a few minutes before we wrap things up here. Meg, keep us honest. Are there any questions that I'm missing here in the chat box, or audience here? You guys send us any more questions, a few more minutes before we cut these guys off.
We do have one that just came into the Q&A section that has to do with estimating EBITDA, like a back of the napkin type of thing. Is it safe to use net income as a rough estimate of what a firm's EBITDA is, or is there a better way to kind of estimate that? And that might be a question that has a little bit deeper roots, but is there anything that we can kind of provide that would give more of that back of the napkin type math?
So I'll go. So I think what I would say is start with net income and then start to add back some of those elements that are implicit in that definition of earnings before your interest, your tax, your depreciation, and amortization. So you can kind of build it back up by adding back some of those things that you've taken out. So you add back your interest. If you have a big bank loan that's driving some interest expense, add back any depreciation and amortization, add back your taxes. That should get you to a closer estimate of EBITDA. I'd also be cautious. One of the things that we see oftentimes is accrual basis versus cash basis accounting. I think everybody on this call is we're interested in accrual basis accounting. So make sure that when you're looking at your EBITDA, assess it on an accrual basis.
The one other thing I'd say for EBITDA, there's kind of two things. One is if there's a lot of depreciation expense, if you're investing in products or capitalizing something, do you have recurring CapEx that's driving the depreciation? So most of the service businesses and government services, there's very little depreciation and amortization. So EBITDA is a good, very representative cash flow. If there's regular ongoing CapEx driving depreciation, the bankers or the people investing may not look at the EBITDA because that depreciation is really representing ongoing investment in CapEx, which is cash, cash going out the door. Then the other thing that looks at EBITDA, which is a little nuance, if you're cost plus and you're overrunning your rates and you're billing, accruing all these, these overruns, and you're not going to be able to collect that for years, you may have significant EBITDA, but all that's growing is your, unbilled, cost overruns that isn't collectible for years. So you'll have EBITDA shown on your income statement, but it's not being translated to actual cash.
Yeah, and I would just add, Katie, real quick, and I think that goes right off this point, is really, at least for us, we use EBITDA as a proxy for free cash flow, which is a slightly more technical definition. I think it's easily Googleable, but it sort of takes into account what Adam talked about a little bit more, which is what we're all care about is the business generating cash from operations as a proxy for how healthy is this business. Now, you may use that cash for CapEx. You may use that cash to pay interest on existing debt. There are a number of different ways you can use the cash. And that essentially is what we're trying to get at, is after all that happens, is there enough cap, at least on the debt side, to be able to service and to be able to pay back the debt? And so those are the things that we look at on the Donovan side.
Well, thank you guys. With that, I'm going to call it a wrap. I do see some other questions that we don't have time to get to, but we'll be following up with you over email to make sure we get those addressed. I want to say thanks to all of our panelists here. Here's their LinkedIn profiles here, so feel free to connect with them on LinkedIn. Going forward, as far as events to look out for from us at GovMates, we'll be sending out information in our next institute coming up probably later this spring. We have 2 virtual matchmaking events coming up, both scheduled for April, one supporting the Center for Industrial Research and Services, and the other supporting the NIST MEP program, the Manufacturing Extension Partnership. So be on the lookout from us at GovMates for emails for those events. So with that, just wanted to say thank you for attending the virtual GovMates Institute. Stay safe and stay sane, everybody.
Thank you, Katie.
Bye-bye.
Thank you.